All right, let's unpack this. Welcome back to the deep dive.
Great to be here.
We plunge into complex subjects, pull out the essential insights, and hopefully leave you feeling truly well informed.
That's the plan.
Today, we're navigating a part of the tax code that can feel, well, like a labyrinth. The world of asset dispositions.
Uh-huh.
Now, that's just IRS speak for when you sell, exchange, or even just, give up property.
Right. Disposition just means getting rid of it somehow.
It sounds a bit dry, I know, but understanding this area isn't just about compliance. It's really about unlocking significant tax-saving opportunities.
And that's precisely our mission for this deep dive. We're going to break down the myriad ways property can change hands, from your personal home to business assets.
Okay.
And most importantly, what each scenario actually means for your tax return. We'll be highlighting smart strategies, the key info you need to optimize your outcomes, and maybe avoid some common pitfalls.
Yeah, finding those aha moments, right?
Exactly. Those moments that can genuinely save you money, or at least prevent a nasty surprise come tax time.
Absolutely. This isn't meant to be a textbook reading. Think of it as a conversation designed to give you a shortcut to becoming, well, tax savvy about your property transactions.
Helping you recognize where the real levers are.
Exactly. So you can approach these situations with confidence and hopefully a much clearer picture of your financial responsibilities and the opportunities. #, understanding the basics of asset dispositions. So before we jump into the specific scenarios like selling a home or dealing with business property, let's lay down the foundational concepts.
Good idea. Gotta have the building blocks.
You think of these as the building blocks for figuring out any gain or loss you might have. Knowing these is really step one to smart tax planning.
That's a great starting point. The very first concept is amount realized.
Okay.
Simply put, this is everything you receive from the disposition of your property.
Everything, like beyond just cash.
Oh yeah, it's not just the literal cash that lands in your bank account. It also includes the fair market value, or FMV, of any other property you receive.
Ah, so I trade something.
Exactly. If you trade one piece of land for another, the value of the land you receive counts. And here's a critical detail that many people overlook.
Uh-huh.
If the buyer assumes a liability from you, like taking over your mortgage on the property, that assumed debt is also part of your amount realized.
Really? Why is that?
Well, it's treated as if you received that money because you're no longer responsible for paying it back. It's an economic benefit to you.
Okay, so it's about the full economic benefit you get from letting go of the asset, not just the check. Got it. What's the other side of that equation then?
The other side is your adjusted basis. This is basically your investment in the property, the figure you measure against what you received.
My investment. So what I paid for it.
It typically starts there with your original cost,
Hmm.
but it's not static. It changes over time. You then add to that original cost the expense of any capital improvements you've made.
Capital improvements, like a new roof or adding a room.
Exactly. Things that add value, prolong its life, or adapt it to new uses. A major extension, a significant upgrade to a business machine, things like that.
Okay.
On the flip side, you subtract things that reduce your investment. The big one here is depreciation deductions you've claimed over the years.
Right, for business or rental property.
Correct. Or any casualty losses you might have deducted for damage to the property. This adjusted basis is absolutely crucial
Why is that?
because it's the number you compare your amount realized against to determine your initial gain or loss. Get the basis wrong, and your gain or loss calculation is wrong.
Let's use a very straightforward example from the source material to kind of tie those two together. Makes it clearer.
Good idea.
Imagine you bought a specific piece of equipment for your business, let's call it a specialized bucket, for, say, $4,000.
Okay, $4,000 cost basis to start.
And over the years, you've properly claimed $3,800 in depreciation deductions on that bucket.
Right, so you've recovered most of the costs through deductions.
So your adjusted basis for that bucket is now only $200. That's the original $4,000 minus the $3,800 in depreciation.
Makes sense.
Now, if you sell that specialized bucket for $800, your realized gain on the sale is $600. That's the $800 you received minus your $200 adjusted basis. Simple math, but wow, that concept is fundamental.
Precisely. And this leads us right into another really important distinction, one that can determine when you actually pay tax.
Okay.
It's the difference between realized gain or loss versus recognized gain or loss.
Okay. Realized versus recognized. What's the difference?
Just because you realize a gain, like the $600 from our bucket example, doesn't always mean it's immediately recognized by the IRS.
And recognized means taxable now.
Exactly. Recognized gain is generally taxable in the current year.
Ugh, here's where it gets really interesting. This is where some of those crucial tax-saving opportunities come into play, right? Where you can maybe delay or even avoid paying taxes on a gain.
That's the core of it. Generally, if you realize a gain, the IRS typically recognizes it. That means it must be included in your gross income for that tax year.
And losses.
Similarly, realized losses are usually deductible, though there are important limits and exceptions, especially for personal property.
Right.
However, and this is where careful planning is absolutely key, there are very significant exceptions to this recognition rule.
Exceptions. Like loopholes. Or intended strategies.
More like intended strategies built into the tax code.
Yeah.
Specific provisions designed to encourage certain economic activities or, to smooth out certain types of transactions. They allow for situations where a realized gain or loss is not recognized for tax purposes in the current year.
So the gain doesn't just vanish.
No, usually not.
Yeah.
It's more like the tax liability is postponed, often until a later date when the property is finally disposed of in a fully taxable event.
So you kick the can down the road, tax-wise.
In many cases, yes. Understanding these non-recognition rules is absolutely fundamental for smart tax planning. They can defer large tax bills for years, maybe even decades in some cases.
Okay, with those foundational concepts amount realized, adjusted basis, realized versus recognized firmly in mind, let's pivot. Let's talk about some specific scenarios you might encounter when disposing of property and how they impact your taxes.
Sounds good. Where should we start?
Let's start with arguably the most significant asset for many individuals, their home.
Right. Personal use property versus business or rental. The type of property you're disposing of dramatically changes its tax treatment. So, yeah, let's start with personal use, specifically the sale of your main home.
Okay.
This is where many individuals can find a substantial tax-saving opportunity. Honestly, it's one of the biggest available to homeowners.
You're talking about the home sale exclusion.
Exactly. The IRS offers a powerful exclusion for gain on the sale of your main home.
How does it work?
If you've owned and lived in the property as your main home for at least 2 years during the 5-year period ending on the date of sale.
The 2 out of 5 rule.
That's the one. If you meet that, you may be able to exclude a significant portion of the gain,
How significant?
up to $250,000, if you're filing as single or married filing separately.
Wow.
And for married couples filing jointly, this exclusion doubles to an impressive $500,000.
$500,000 tax-free.
Potentially.
Yes.
If your gain is less than or equal to that amount and you meet the tests, it's completely tax-free. Think about it. $500,000 in gain, untaxed. That's a game changer for many homeowners building equity over time.
That truly is a massive benefit. It really encourages homeownership, provides a real boost. But what if someone used part of their home for a business, like a dedicated home office, or maybe rented out the basement? Does that complicate the exclusion?
It absolutely does.
Yeah.
It adds a layer of complexity. If you used a portion of your home for business or rental purposes, the gain or loss calculation essentially gets split.
Split.
Well, the personal use portion of the home still qualifies for the main home exclusion, assuming you meet the ownership and use tests for that part.
Okay, so you still get the benefit for the part you lived in.
Right. However, the part of the gain attributable to the business or rental use is not eligible for this exclusion.
Ah, okay. So what happens to that part of the gain?
For that portion, you'll typically treat it as a sale of business property. Any gain or loss on that business or rental part might be classified as capital or ordinary, and it would generally be reported on Form 4797.
Form 4797. That's the business property form, right?
Correct. It requires careful allocation. You need to figure out how much of the sale price in the adjusted basis applies to the personal part versus the business part. Often needs good records of square footage or how long you used it for business.
That makes sense. The IRS wants to differentiate between personal benefits and business gains. So, following that idea, what about losses on other personal use property? Say I sell my old car for less than I paid for it, or I have a yard sale and sell furniture for pennies on the dollar. Can I deduct those losses?
That's a common question, and unfortunately the answer is generally no.
No deduction at all.
Nope. Losses on personal use property, like your car, your furniture, your boat, other household items, are not deductible for tax purposes.
Hmm.
Even if it feels like a big financial loss, the IRS doesn't allow a deduction for it.
Good to know.
But there's a reporting nuance here. If you happen to receive a Form 1099-S, which usually reports real estate sales, for the sale of personal use property, maybe a vacation home sold at a loss,
Yeah.
you still have to report that transaction on Form A949 and Schedule D. Even though the loss itself won't be deductible, the IRS still wants to see the transaction reported if that form was issued.
So you report it, but you don't get a tax break for the loss.
Exactly. It's a crucial distinction. Assets for personal enjoyment versus assets held for investment or business.
All right, so we've covered sales, planned, and maybe a bit complex with mixed use. But what about when you simply walk away from something? You abandon a piece of property. You just give up ownership without selling it. How does the IRS treat that?
That's a great question. And it's another area where, surprisingly, tax planning can yield benefits. Abandonment is indeed a form of disposition.
How is it defined?
It happens when you voluntarily and permanently give up possession and use of property with the clear intention of ending your ownership. And crucially, you do it without passing it on to anyone else. It's not a sale, it's not an exchange, you just walk away.
Okay, so what's the tax impact?
The key tax-saving insight here, and this is a significant one for investors and businesses, is that a loss from the abandonment of business or investment property is generally deductible as an ordinary loss.
Ordinary loss, not capital loss.
Correct. Ordinary loss. This is very important because ordinary losses can offset ordinary income like your salary or other business income, which is often taxed at higher rates than capital gains.
Can you give an example?
Sure. Let's say you own a piece of land you intended for future development, held purely for investment. Then environmental surveys reveal it's completely unusable, contaminated, worthless. You might choose to formally abandon it.
Okay.
Since it was held for investment, that loss, your adjusted basis in the land, could potentially offset your wages or other active income, generating a significant tax saving. The same logic applies to things like leasehold improvements a landlord made for a tenant, and then the tenant leaves and the improvements are abandoned.
Interesting. So abandonment isn't always a bad thing, tax-wise, if it's business or investment property?
Not always. And there's another layer here for certain business assets. For tangible depreciable property used in a business or for income production after 1986, what we call MCRS assets.
MSCRS Modified Accelerated Cost Recovery System, the depreciation system.
Exactly. For those MCRS assets, you can actually elect to recognize a loss or even a gain on a partial disposition.
Partial, like part of a machine.
Precisely. If a specific component of a larger asset is retired or abandoned, maybe a key part of a production line becomes obsolete and you remove it, you can often claim the loss on just that component without having to get rid of the entire asset.
How do you do that?
You make the election by reporting it on a timely filed tax return, usually on Form 4797. This allows businesses to get a current deduction for parts of assets that are no longer useful, even if the main asset keeps running. It helps accurately reflect economic reality.
That's a valuable nuance for businesses, definitely. Not having to scrap the whole machine is useful.
Yeah.
Now, let's move to situations where the disposition isn't entirely your choice, where, life happens and external forces compel you to give up your property. We're talking about involuntary conversion.
Yes, involuntary conversions. This happens when your property is destroyed, like by fire or flood, stolen, condemned, or disposed of under the threat of condemnation.
Threat of condemnation, like the government says they might take it.
Exactly. If there is a credible threat, even if they haven't formally condemned it yet, a sale under that threat can qualify. And in return for the property, you receive other property or money, like an insurance payout or a condemnation award.
What's a common example?
Probably the most common is when a government entity, city, state, federal, exercises its power of eminent domain. They condemn your property for public use, like building a new highway, a school, or a park. Your property is essentially taken, and you receive compensation.
So how is the gain or loss treated? Is it just like a sale?
Generally, yes. Gain or loss from an involuntary conversion is usually recognized for tax purposes, just like a regular sale. Calculate your amount realized, the insurance money or award, minus your adjusted basis.
But are there exceptions?
There's a crucial caveat for losses on personal use property. Similar to what we discussed with sales, losses on personal use property from an involuntary conversion are not deductible, unless they result specifically from a casualty or theft. Those fall under different specific rules detailed in IRS Publication 547. But for condemnation or destruction of personal property leading to a loss, generally no deduction.
Okay, but what about gains? Is there a way to soften the tax blow if, say, my building burns down and the insurance payout is more than my basis?
Yes. And this is the big tax-saving strategy for involuntary conversions. It can allow you to put off paying tax on a significant gain, sometimes indefinitely.
Okay, I'm listening. This sounds crucial, especially after something unexpected like that. How do you defer the tax?
The main benefit here is the ability to postpone reporting the gain. There are two main ways this works.
No.
First, if you receive only replacement property that is similar or related in service or use to the property that was converted.
So, like, you trade the condemned land directly for other similar land.
Exactly. In that rare case, you generally don't have to report the gain at all. It's a direct non-recognition event. Your basis in the new property just carries over from your basis in the old one.
Okay, but usually you get cash, right? Insurance money or a government check.
Much more common, yes.
Yeah.
If you receive money or property that is unlike what was converted, you can elect to postpone reporting your gain.
Elect. So it's a choice.
It's an election you make on your tax return. To qualify for the postponement, you must buy replacement property that is similar or related in service or use within the specific replacement period.
And if you do that,
Then you only recognize gain to the extent that the amount you realize,
yeah.
the insurance money, etc., exceeds the cost of the replacement property. If you reinvest all the proceeds, you could potentially defer the entire gain.
Okay, so the key is reinvesting in similar or related property. What exactly does that mean? It sounds a bit vague.
It is critical, and the definition depends on how you use the original property. For an owner-user, meaning you use the property yourself, like your main home or a factory you operated,
Yeah.
the replacement property must function in the same way for you. If your home was condemned, replacing it with another home qualifies. Taking the insurance payout and buying a grocery store to rent out, that would not qualify. It has to serve the same function for you.
Got it. Same function. What about for an investor, like someone who owned a rental property that was destroyed?
For an owner-investor, similar or related in service or use is interpreted differently. It's less about the physical characteristics and more about the relationship of the property to you as the investor.
How so?
You look at factors like, are the properties of similar service to you? What's the nature of the business risks involved? What do they demand from you in terms of management, services to tenants, and general oversight?
So if I owned a retail rental building that burned down, could I replace it with an apartment building and still qualify?
Potentially, yes. If your role as the investor, your management duties, the types of services you provide tenants, the business risks you face are sufficiently similar between the retail property and the apartment building, it could qualify. It's about your ongoing role and the investment's nature, not just that both are buildings.
That's a really important distinction. It focuses on the owner's relationship to the asset. Now,
Yeah.
for real property specifically, does that like-kind standard we hear about with exchanges come into play here too?
Yes, it does, and it provides more flexibility. For real property that you held for productive use in a trade or business, or for investment, so not your personal home, generally property that is like-kind is generally treated as similar or related in service or use for involuntary conversion purposes.
And like-kind for real estate is pretty broad, right?
Very broad. Essentially, any U.S. real estate held for business or investment is like-kind to any other U.S. real estate held for business or investment. So if your investment farmland is condemned, you could replace it with a rental office building and still potentially defer the gain under this rule.
That definitely broadens the options. What about the timing? You mentioned a replacement period. How long do you have?
The replacement period is also vital. Generally, you have 2 years after the close of the first tax year in which you realize any part of the gain from the conversion.
2 years from the end of the year, you get the money.
Essentially, yes. However, for the condemnation of real property held for business or investment, that period is generously extended to 3 years.
3 years for business, investment, real estate. Okay.
And there are even longer periods for specific situations. For instance, it's 4 years for a main home, or its contents located in a federally declared disaster area.
That makes sense. Gives people time to recover.
Right. And for livestock sold due to weather-related conditions like drought or flood in areas eligible for federal aid, the period can also be 4 years, and sometimes even longer if the adverse conditions persist. The IRS often issues notices, like Notice 2024-70 recently, extending these periods for ranchers in affected areas. This flexibility is key.
Absolutely. Now, what if only part of my property is condemned? Like, the state takes a strip of my land for a road, but I keep the rest. And maybe they pay me severance damages because the remaining part is now less useful or valuable. Can that gain be postponed too?
That's an excellent point, and yes, it often can. Severance damages received because a portion of your property was condemned are treated as an amount realized from an involuntary conversion of the remaining property.
So it's like a separate conversion event for the part I kept?
Kind of. You can elect to postpone reporting the gain attributable to those severance damages just like the gain on the part that was actually taken.
How does that work with a reinvestment?
The key is to reinvest the full amount received, both the condemnation award for the taken portion and the severance damages for the remaining portion, into qualifying replacement property. If the replacement property costs at least as much as your net severance damages, plus any net condemnation award that resulted in a gain, you can postpone all the gain. It's about reinvesting the total economic benefit received.
Okay, that covers the reinvestment. How do we report all this? Where does it go on the tax forms?
Good question. If you have a gain from a condemnation of personal use property,
Hmm.
other than gain you exclude or postpone on your main home, you'll report it on Form 8949, Sales and Other Dispositions of Capital Assets.
Form 8949.
Right. And then the totals flow to Schedule D, Capital Gains and Losses. Remember, though, losses on personal use property are generally not deductible. But if you get a Form 1099-S for it, you still report the transaction, showing a non-deductible loss.
Okay. And for business property?
For business or investment property, gains or losses from involuntary conversions, including any postponed gain calculations, are reported on Form 4797, Sales of Business Property. That's the main form for business asset sales and conversions. Knowing which form to use is crucial for compliance and for properly claiming any postponements.
Now, let's talk about perhaps the most well-known and often utilized tax deferral strategy, especially in the world of real estate investing, like-kind exchanges. Section 131 exchanges.
Ah, yes. Section 131, often called the ultimate tax deferral tool for real estate investors, and for good reason.
So what qualifies? What's the core idea?
What qualifies is the exchange of real property held for productive use in a trade or business, or for investment.
So not your personal residence or property held primarily for quick resale?
Exactly. Held for business use or investment. You exchange that for other like-kind real property. The beauty, the main benefit, is the non-recognition of gain or loss.
Non-recognition again, meaning you defer the tax.
Precisely. The tax liability on any built-up gain is effectively deferred until the replacement property is eventually sold in a fully taxable transaction down the line. This lets investors continually reinvest their gains and equity into larger or different properties without that immediate tax hit. It creates a powerful compounding effect over time.
Sounds great. What are the catches? The requirements?
There are crucial requirements that must be met meticulously. First, both the property you give up, the relinquished property, and the property you receive, the replacement property, must be like-kind.
And for real property, like-kind is broad.
Incredibly broad, yes.
Yeah.
Essentially, any real property located in the U.S. that's held for business or investment is considered like-kind to any other U.S. real property held for business or investment. Improved, unimproved, raw land for an apartment building, office for retail, generally okay.
But only real property now, right? Didn't this used to apply to other things?
Critical point.
Yeah.
Yes. Recent tax law changes eliminated like-kind exchange treatment for personal property. So no more exchanging business equipment, vehicles, artwork, or collectibles tax-deferred under Section 1031. It's now solely for real property.
Okay, only real estate. What else?
For deferred exchanges, which is how most 1031s happen, because finding someone to swap properties directly is rare. There are very strict identification and receipt deadlines.
The famous deadlines, what are they?
You must formally identify potential replacement properties in writing within 45 days of selling your relinquished property.
45 days, that's tight.
It is. And you must actually receive the replacement property within 180 days of selling your relinquished property, or are, by the due date, including extensions, of your tax return for the year of the sale, whichever date comes first.
180 days total. Wow. Miss either deadline.
Even by 1 day, and the entire transaction typically becomes taxable, the deferral is lost. That can trigger a huge, unexpected tax bill. Strict adherence is non-negotiable.
Okay, super strict deadlines. Now, what if someone receives some cash in the deal? Or maybe property that isn't like-kind? Does that blow the whole thing or just part of it?
That's what we call the boot problem, and it's where the deferral might not be complete.
Boot, like pirate treasure.
Maybe feels like it if it triggers tax. Boot refers to money or any non-like-kind property received in the exchange.
So cash, or maybe a car thrown into the real estate deal.
Exactly. Or, very commonly, if the other party assumes your mortgage or other debt on the property you're giving up, that debt relief is treated just like receiving cash. It's boot.
Okay, so if you receive boot,
You generally recognize gain, meaning you pay tax currently, but only to the extent of the value of the boot you received. Your realized gain might be much larger, but your recognized gain is capped by the amount of boot.
can we walk through that? An example makes it stick?
Sure. Let's use the example from the source. Imagine you exchange a rental property you own. Your adjusted basis is $80,000.
Okay, 80 Talkes basis.
In return, you receive like-kind property with a fair market value of $100,000. Plus, you get $10,000 in cash. And the other party assumes your $30,000 mortgage on the property you gave up. Let's also say you paid $5,000 in exchange expenses, like broker commissions.
Okay, a lot of moving parts. What's the first step?
First, calculate your total amount realized. That's the $100K FMV of the new property, plus the $10K cash, plus the $30K mortgage relief. That's $140K total value received. Then subtract your $5K exchange expenses. So your amount realized is $135,000.
135K realized. Okay, now the gain.
Your realized gain is the amount realized minus your adjusted basis. $135,000,
Right.
$80,000, $55,000. That's your total economic profit on the deal.
$55,000 gain. But how much is taxed now?
Now we look at the boot. You receive $10,000 in cash and $30,000 in mortgage relief. That's $40,000 total boot received.
Right.
However, you can generally offset the boot received with cash boot paid or exchange expenses paid. Here, you paid $5,000 in expenses. So your net boot is $40,000 minus $5,000, which equals $35,000.
Okay, net boot is 35K.
Your recognized gain, the taxable amount this year, is the lesser of your realized gain, $55,000, or your net boot received, $35,000.
So $35,000 is recognized.
Exactly. Even though you realize a $55,000 gain, you only recognize and pay tax on $35,000 in the current year. The remaining $20,000 of gain, 55K, 35K, is successfully deferred into the basis of the new property.
Wow. That example perfectly shows how boot triggers some tax, but you still get significant deferral. Careful calculation is key.
Absolutely critical.
And to make sure you don't accidentally touch the money from the sale, which would trigger tax, that's where qualified intermediaries come in, right? They're essential.
Essential is the right word. Qualified intermediaries, or QIs, sometimes called facilitators or accommodators, are absolutely crucial for any deferred like-kind exchange.
What's their role?
They played a very specific, legally required role as a neutral middleman. The QI takes legal title to the property you're giving up, the relinquished property, sells it, holds the proceeds in a secure escrow account.
So you never actually received the cash.
Correct. That's the key. The QI then uses those escrowed funds to acquire the replacement property you identified and then transfers title of that replacement property to you to complete the exchange.
Why is that structure so important?
It helps you avoid actual or constructive receipt of the exchange funds. If you directly receive the cash from the sale, even if you fully intend to immediately reinvest it in replacement property, the IRS generally treats it as a taxable sale, not a deferred exchange. Your entire gain becomes immediately taxable. The QI acts as a safe harbor to prevent that by ensuring you never have control over the cash.
Makes sense. Are there rules about who can be a QI? Can my accountant do it?
Good question. There are strict rules. Your QI cannot be a disqualified person.
Disqualified person, meaning?
Generally, that means someone who has acted as your agent within the 2-year period ending on the day you transfer your relinquished property. This includes your employee, your attorney, your accountant, your investment banker or broker, or your real estate agent or broker.
So pretty much anyone who's worked for me recently in those professional roles?
Largely, yes. The IRS wants the QI to be a truly independent party to the exchange to prevent potential conflicts of interest or abuse. There are some narrow exceptions, like for routine financial services from a bank, but generally you need an independent, specialized QI company.
Okay, good to know. What about doing exchanges with family or my own company? Are there special rules there?
Yes, definitely. Special rules apply to like-kind exchanges between related persons.
Who counts as related?
It includes close family members, your spouse, siblings, parents, children, grandchildren, etc. It also includes entities where you hold more than 50% ownership, directly or indirectly, like a corporation or a partnership you control.
So what's the special rule?
If you engage in a like-kind exchange with a related person, and either you or the related person disposes of the property received in the exchange within 2 years of the original exchange,
Oh.
then the original exchange is disqualified from non-recognition treatment. The gain or loss that was deferred on that original exchange must be recognized as of the date of that later disposition. It basically undoes the deferral retroactively.
Wow, a 2-year holding period for both parties. Why that rule?
It's an anti-abuse rule.
Mm.
It prevents related parties from simply swapping properties with different bases to effectively cash out of an investment without triggering tax, or
Yeah.
shifting gains and losses in ways that wouldn't happen in an arm's length deal.
Okay, that makes sense. Where do you report these 10,031 exchanges?
All like-kind exchanges, without exception, are reported on Form 8824, like-kind exchanges. It requires detailed information about both properties, the timeline, any boot, and related party involvement.
That 2-year rule for related parties is a big one. Really underscores that the IRS watches those closely.
Okay, moving beyond real estate now. What about other significant assets,
Hmm.
especially ones with maybe unique tax treatments or specific rules listeners might encounter?
Yeah, let's get into dispositions of specific asset types. This is where some really powerful and sometimes overlooked tax-saving opportunities can be found.
Like what?
One of the most impactful, especially for entrepreneurs, startup employees, and early-stage investors, is qualified small business stock, or QSBS.
QSBS. Heard of it. Sounds important.
It offers a truly remarkable tax advantage designed to encourage investment in small, growing businesses. QSBS is stock that was originally issued by a qualified small C corporation after August 10th, 1993. The company has to meet several stringent tests, things like having gross assets below a certain threshold, being engaged in an active qualified trade or business, and not being in certain excluded industries.
Okay, so specific stock from specific types of companies. What's the tax break? If you sell QSBS that you've held for more than 6 months, you actually have two potentially incredible tax-saving options.
Those options, okay?
First, there's a rollover provision. You can elect to roll over the capital gain tax-free into other QSBS that you buy within 60 days of the sale.
So sell one startup investment, reinvest in another, no tax now.
Exactly. It allows you to defer the tax liability, similar to a 1031, but for qualifying stock.
Yeah.
You only recognize gain if the amount you got from the sale is more than what you paid for the replacement QSBS.
That's pretty good. What's the second option? You said it was maybe even more powerful.
Yes, the second option is the exclusion of gain. If you hold QSBS for more than 5 years,
5 years, okay.
you may be able to exclude a significant portion or potentially even all of your gain from your gross income permanently.
Exclude, not just defer, like tax-free profit.
Potentially, yes.
Yeah.
Depending on when you acquired the stock, the exclusion could be 50%, 75%, or for stock acquired after September 27, 2010, it could be a full 100% exclusion.
100%.
100%. Up to certain limits, of course. But this means all the profit you make from selling that qualifying stock, held over 5 years, can be completely tax-free. It doesn't just defer the tax, it eliminates it.
That is huge. What are the limits?
The exclusion in any given year is generally limited to the greater of 10 times your original basis in the stock, or $10 million of gain per issuer of the stock. $5 million if you're married, filing separately.
Still, $10 million tax-free gain potential. That's incredible for successful founders or early investors. A definite aha moment there.
Absolutely. It's one of those generous incentives in the tax code, specifically aimed at fueling small business growth. Definitely something to look into if you have stock in a potentially qualifying company.
Wow, 100% exclusion. Okay, moving to something much newer. What about digital assets? Cryptocurrencies, the IRS seems to be paying a lot more attention there lately.
We're absolutely right. Digital assets are a rapidly evolving area, and the IRS has definitely stepped up its focus and guidance. Well, for starters, beginning with the 2020 tax year and continuing for 2024 and beyond, the IRS put a question right on the front page, page 1, of Form 1040 and 1040 SR.
The checkbox question.
Exactly. It asks if, at any time during the year, you engaged in any transaction involving digital assets. You have to check yes or no.
And any transaction means.
It's very broad. It's not just about selling crypto for US dollars.
Okay, what else counts?
Taxable events involving digital assets include receiving crypto as payment for goods or services, earning crypto through mining or staking rewards, receiving new digital assets from a hard fork, exchanging one type of crypto for another, like trading Bitcoin for Ethereum.
Wait, crypto-to-crypto trades are taxable?
Yes, that's a big one people miss. Exchanging one crypto for another is treated like selling the first one and buying the second one. It's a disposition that triggers potential gain or loss.
Okay, what else?
Also, exchanging digital assets for any property, goods, or services. So using Bitcoin to buy a coffee or a car or anything else. And of course, selling crypto for fiat currency like dollars.
Basically, almost anything you do with crypto other than just buying and holding it could be a taxable event.
Pretty much. Any disposition where you give up your financial interest or control is likely taxable.
So how do you report it if you have a gain or loss?
If you hold these digital assets as a capital asset, which is usually the case for investors, and you dispose of them.
Mm-hmm.
You use Form 8949 to figure your capital gain or loss, transaction by transaction, and then you summarize those results on Schedule D of your Form 1040, just like you would for stocks or bonds.
Which means you need records, right? Cost basis, sale price?
Meticulous records are absolutely crucial. You need to know your cost basis for every unit of crypto you acquire, including fees, and the fair market value in US dollars at the time of every single transaction, acquiring it, exchanging it, selling it. Without good records, accurately calculating your gains and losses can be a nightmare.
That sounds like a lot to track, especially with frequent trading.
Okay, speaking of multiple assets, what happens when someone sells an entire business? It's clearly not just one item being sold, is it? Exactly. That's a really important point. Selling an entire business is rarely, if ever, treated as the sale of a single asset for tax purposes.
So how does the IRS view it?
Instead, the IRS treats it as the sale of all its underlying individual assets, piece by piece.
Piece by piece, like the furniture, the equipment, the customer list.
Precisely. For tax purposes, you have to classify each asset being sold. Is it a capital asset? Is it depreciable property used in the business, what we call Section 123D1 property? Is it real property? Is it inventory held for sale to customers? Is it accounts receivable? Even intangible assets like goodwill.
And you calculate gain or loss on each one.
Separately, you figure the gain or loss for each and every asset being transferred as part of the sale. It can be a very detailed and complex process.
How do you figure out how much of the total sale price goes to each asset if someone just pays me a lump sum for my whole company?
That's where allocation comes in. Both the buyer and the seller are generally required to use a specific method called the residual method to allocate the total purchase price among the various assets transferred.
The residual method.
Yes. It categorizes assets into different classes.
Yeah.
From Class 1, cash and equivalents, up through Class 7, goodwill and going concern value. You allocate the purchase price first to Class 1 assets up to their value, then Class 2, and so on. Whatever's left over after allocating to all the identifiable tangible and intangible assets usually gets assigned to Class 7, goodwill.
And this allocation matters. Why?
It matters hugely for both sides. For you, the seller, how the price is allocated determines the character of your gain or loss on each asset. Selling inventory results in ordinary income. Selling depreciable equipment might trigger ordinary income recapture, which we'll get to, plus potentially Section 1231 gain. Selling goodwill usually results in capital gain. The allocation directly impacts your tax bill.
And for the buyer.
For the buyer, the allocation determines their basis in each asset they acquire. This basis is what they'll use for future depreciation deductions, or to calculate their own gain or loss when they eventually sell those assets. So both buyer and seller have a vested interest in the allocation, and they generally must agree on it and report it consistently to the IRS using Form 8594. Often requires professional valuation help.
That sounds incredibly complex. Definitely need experts involved there. What about selling just intangible property on its own, like patents, trademarks, copyrights, customer lists, or goodwill? Do they have their own special rules?
They certainly do. Intangible property dispositions have specific rules, especially for assets acquired after August 10, 1993, many of which fall under the category of Section 197 intangibles.
Section 197. What are those?
These include things like goodwill, going concern value, workforce in place, customer lists, patents, copyrights, formulas, franchises, trademarks, and trade names acquired as part of buying a business. They generally have to be amortized over a 15-year period for tax purposes.
Okay, amortized over 15 years. What happens when you sell one?
There's a unique loss limitation rule. If you acquire multiple Section 197 intangibles in a single transaction, or a series of related transactions.
Like when buying a whole business.
Exactly. And later, you dispose of one of those intangibles at a loss, but you still hold other Section 197 intangibles from that same original acquisition.
Yeah.
You generally cannot deduct that loss in the current year.
Can't deduct the loss. What happens to it?
Instead, the non-deductible loss is added to the adjusted basis of the retained Section 197 intangibles from that same deal. It increases their basis.
So you get the tax benefit eventually, just deferred until you sell the rest.
Essentially, yes. It prevents taxpayers from selectively selling off the loss-generating intangibles early while keeping the appreciated ones, accelerating loss deductions.
Interesting rule. What about specific types, like patents? Are they treated differently?
Patents often get favorable treatment, especially when transferred by an individual inventor or someone who acquired an interest before it was reduced to practice. The transfer can be treated as a sale or exchange of a capital asset. usually long-term capital gain if held over a year.
Capital gain. That's usually better than ordinary income.
Right. And this capital gain treatment can apply even if the payments are made periodically over time or if they're contingent on the patent's productivity, use, or disposition, as long as all substantial rights to the patent property are transferred.
All substantial rights, meaning you really give up control.
Pretty much, you have to transfer the exclusive right to make, use, and sell the invention throughout a country.
Okay. What about franchises, trademarks, or trade names? Similar treatment.
Here's where it can differ significantly. If you, as the transferor of a franchise, trademark, or trade name, retain any significant power, right, or continuing interest over it.
Like what kind of rights?
Things like the right to disapprove any assignment, the right to terminate the agreement at will, the right to prescribe quality standards for products or services, require the transferee to buy supplies from you, or receive payments contingent on productivity.
If you keep those kinds of controls.
Then the amounts you receive are generally treated as ordinary royalty income, not as proceeds from a sale qualifying for capital gain treatment.
Wow. So retaining too much control flips capital gain into ordinary income.
Exactly. The structure of the deal and the rights retained are absolutely critical for determining the tax character of the payments. Devil's in the details of the agreement.
That's a critical distinction indeed. It really highlights the need for careful structuring of those deals. Now, are there special rules when the transaction involves, say, family members or maybe close business partners? It feels like the IRS always has a closer look at those related party transactions.
They absolutely do, and for good reason. The tax code has specific rules for sales and exchanges between related persons, designed to prevent taxpayers from essentially creating artificial gains or losses just for tax benefits through deals that aren't truly arm's length.
Okay, so what are the key rules?
There are two big ones to watch out for. First, regarding gains. If you recognize a gain on the sale or exchange of depreciable property to a related person.
Depreciable property, like buildings or equipment.
Right. Or if the gain arises from a transaction involving a controlled partnership, that gain may be treated as ordinary income.
Ordinary income, even if the asset itself would normally produce capital gain if sold to an unrelated party?
Correct. Even if it's technically a capital asset or Section 1231 property, selling it at a gain to a related person can convert that gain into ordinary income, which is often taxed at higher rates.
Who counts as related here? Same definition as for the 1031 rule.
Generally similar, yes. Close family members, spouse, siblings, parents, children, ancestors, lineal descendants, and entities where you have more than 50% ownership or control, like a corporation or partnership.
Hmm.
The rules aim to stop related parties from selling appreciated depreciable assets back and forth just to step up basis or manipulate income character.
Okay, that's the gain rule. What's the other big one you mentioned too?
The second one concerns losses. This rule is even more strict. A loss on the sale or exchange of property, whether directly or indirectly, between related persons is not deductible, period.
Not deductible at all. So if I sell stock to my sister at a loss, I get no tax benefit.
Correct. You cannot claim that loss on your tax return. The IRS prevents you from generating a tax loss by simply shifting an asset to a closely related party.
Okay, no loss deduction for me, the seller. Is there any benefit down the road? Maybe for my sister, the buyer.
Yes, there's a potential silver lining for the related person who bought the property from you, your sister in the example.
How does that work?
If she later sells that same property for a gain to an unrelated third party, she generally only recognizes gain to the extent that her gain exceeds the amount of the loss that was previously disallowed to you.
Okay, run that by me again. Maybe with numbers.
Sure. Let's say your sister sells stock to you for $7,600. Her original cost basis was $10,000. So she has a $2,400 realized loss, $10K, $7, $6K.
Right, but she can't deduct that $2,400 loss because she sold it to you, her brother.
Exactly. Her loss is disallowed. Now, your basis in the stock is $7,600, which you paid. Later, you sell that same stock to someone completely unrelated for $10,500.
Okay, I sold it for $10,500. My basis was $7,600. So my realized gain is $2,900.
Correct. Your realized gain is $2,900.
All right.
Because your $2,900 realized gain is reduced by the $2,400 loss that was previously disallowed to your sister. $2,900 gain, $2,400 disallowed loss equals $500 recognized gain.
So I get the benefit of her previously disallowed loss when I sell it at a gain.
Precisely. This rule helps to mitigate the harshness of the disallowed loss rule, ensuring that the overall economic gain or loss on the asset is eventually accounted for across the related parties, even if the initial deduction was denied. It prevents the loss from vanishing entirely from the tax system.
That's fascinating how the IRS tracks that disallowance across related parties, really underscores the importance of knowing who you're transacting with. Okay, now let's talk about something that can truly sneak up on people. It can drastically change what they thought was a nice capital gain into potentially higher taxed ordinary income. You mentioned it earlier, depreciation recapture. Sounds ominous, like the IRS clawback.
Depreciation recapture is precisely that the IRS clawing back a tax benefit you received in the past. It's a really important concept for anyone selling business or investment property.
How does it work? Why the clawback?
If you dispose of depreciable or amortizable property at a gain, a portion, or sometimes even all of that gain, may be reclassified from capital gain or Section 1231 gain to ordinary income.
Reclassified to ordinary income.
Why? Because you previously reduced your ordinary taxable income over the years by claiming depreciation or amortization deductions on that asset. Those deductions offset ordinary income. When you sell the asset for more than its depreciated value, its adjusted basis, the IRS essentially says, hey, part of that gain is just getting back the ordinary income deductions you took earlier. So they want to tax that portion at ordinary income rates.
So it prevents converting ordinary deductions into later capital gains.
Exactly. To correctly figure this recapture, you absolutely must keep permanent, detailed records of all depreciation allowed or allowable on your property year after year. Without those records, calculating recapture accurately is nearly impossible, and the IRS may assume the maximum possible recapture.
Okay, good records are key. Are there different types of recapture?
Yes, there are two main types governed by different sections of the tax code, Section 1245 and Section 1250.
Okay, let's break those down. What's Section 1245?
Section 1245 recapture applies primarily to depreciable personal property. This includes both tangible property like machinery, equipment, vehicles, furniture, and fixtures, and also certain intangible property like patents or copyrights that you've amortized.
So mostly stuff that isn't real estate.
Generally, yes. It also covers other tangible property that isn't a building or its structural components if that property was used integrally in manufacturing, production, extraction, or furnishing transportation, communications, or other public utility services. But the key exclusion is buildings and their structural components. Those fall under Section 1250.
Okay, so 1245 is for equipment, vehicles, etc. What's the recapture rule?
The recapture rule for Section 1245 property is quite straightforward and, frankly, quite aggressive. Any gain you have on the disposition of Section 1245 property is treated as ordinary income to the full extent of all depreciation or amortization allowed or allowable on that property since you acquired it.
All of it, dollar for dollar.
Dollar for dollar, up to the amount of your total gain. Any gain above the total depreciation taken would then typically be treated as Section 1231 gain.
Let's use an example, that van we talked about earlier.
Perfect. Bought for $30,000, depreciated by $25,000, adjusted basis is $5,000, you sell it for $28,000.
Right. Total gain is $23,000. 28K sale, 5K at basis.
Under Section 1245, you look at the total depreciation taken, $25,000. Your gain, $23,000, is less than the total depreciation. Therefore, the entire $23,000 gain is recaptured and treated as ordinary income. None of it gets Section 1231 capital gain treatment.
Wow. So basically all the depreciation you claimed comes back as ordinary income first, up to the amount of your gains. That's significant for businesses selling equipment.
Very significant. It often means the entire gain on selling used equipment is taxed at ordinary rates.
Okay, that's Section 1245. What about Section 1250 property? You said that covers buildings and structures.
You're exactly right. Section 1250 property includes all depreciable real property, like buildings, warehouses, rental houses, apartment complexes, that is not and never has been Section 1245 property. Crucially, this does not include the land itself because land isn't depreciable.
So buildings and their structural components, what's the recapture rule here? Is it as tough as 1245?
Generally, no. The recapture rule for Section 1250 property is usually less aggressive. Gain on the disposition of Section 1250 property is treated as ordinary income only to the extent of what's called additional depreciation.
Additional depreciation, what's that?
Additional depreciation is the amount of depreciation you claimed that exceeded the amount you would have claimed if you had used the straight line method of depreciation from the start.
So if you used an accelerated depreciation method in the past.
Exactly. Historically, some real property allowed accelerated methods where deductions were larger in the early years. Section 1250 was designed to recapture the extra depreciation taken beyond the basic straight line amount.
But Don't most real estate investors have to use straight-line depreciation now?
Ah, that's the very important point for most people today. For most residential rental property and non-residential real property placed in service after 1986, the tax law generally requires you to use the straight line method. Over 27.5 years for residential, 39 years for non-residential.
So if I'm using straight line, I don't have additional depreciation.
Correct. If you've consistently used the required straight line method and held the property longer than 1 year, you generally will not have any additional depreciation.
Meaning no Section 1250 ordinary income recapture.
Generally, yes. For many sales of rental properties or commercial buildings placed in service after 1986, there's often zero Section 1250 ordinary income recapture because only straight-line depreciation was taken. The gain would then be primarily Section 1231 gain.
That's much better than the Section 1245 rule. Is there any catch?
There is a related concept called unrecaptured Section 1250 gain. Even if there's no ordinary income recapture, the portion of your long-term capital gain that's attributable to the straight-line depreciation you did take is typically taxed at a maximum rate of 25%, which might be higher than your regular long-term capital gains rate, which could be 0%, 15%, or 20%.
Okay, so the depreciation part of the gain gets potentially taxed at 25%, but not necessarily converted to ordinary income.
Correct. It's a special category of capital gain. Still often better than ordinary income rates, but maybe not as good as the lowest capital gains rates.
Good to know. Any other wrinkles with Section 1250?
One more mainly for businesses. C corporations, but not S corporations, face an additional ordinary income recapture hit on Section 1250 property. They have to treat 20% of the excess of the Section 1245 recapture amount, what recapture would have been if it were 1245 property, over the actual Section 1250 recapture amount as ordinary income. It's a complex rule, basically adding more ordinary income for C Corp selling depreciable real estate.
Okay, so for most individual investors using straight line on rentals acquired after 86, the main Section 1250 ordinary income recapture isn't a huge concern, but they need to be aware of the potential 25% rate on the depreciation part of the gain. That's helpful. But what about recapture in those tax-deferred transactions, like a 1031 exchange or an involuntary conversion? Does the recapture potential just vanish if the gain is deferred?
Not necessarily. Recapture can still bite you even in otherwise tax-deferred transactions.
How?
If you receive boot money or non-like-kind property in a like-kind exchange or involuntary conversion, some of that recognized gain, remember gain recognized is limited to boot, might be treated as ordinary income due to recapture first, before any is treated as capital gain.
So the boot triggers the recapture first.
Often, yes. Also, recapture can be triggered if you exchange, say, Section 1245 property, like equipment, and receive Section 1250 property, like a building, in return, even if no cash changes hands. The IRS might say you disposed of the 1245 property without receiving sufficient 1245 property back, triggering recapture on the gain attributed to the 1245 asset.
Wow, okay. What happens to recapture potential that isn't triggered in the exchange? Does it just disappear?
No, it generally doesn't just disappear. Any ordinary income from depreciation recapture that is not reported in the year of the disposition, because the recognized gain was limited, for example, is effectively carried over to the new replacement property.
Carried over? How?
It taints the basis of the new property. When you eventually dispose of that new property in a taxable transaction, that carried over recapture potential will likely be triggered then. It essentially defers the ordinary income recognition rather than eliminating it completely.
So the recapture potential follows the investment.
Exactly, which again highlights why meticulous record-keeping across multiple transactions, sometimes spanning decades in several exchange properties, is absolutely paramount.
Yeah.
You need to know the depreciation and recapture history embedded in the property you acquire, especially via exchange. #tag key forms for reporting.
This has been incredibly detailed. We've broken down complex rules, found some really significant tax-saving strategies. But at the end of the day, all these sales, exchanges, abandonments, they have to end up somewhere on your tax return, right?
Absolutely. Compliance means getting it on the right forms.
So where do these different types of asset dispositions actually get reported? What are the main forms listeners should be aware of?
That's a critical question. Using the right form ensures compliance, helps you properly claim exclusions or deferrals, and correctly calculate your tax. There are a few main forms you'll encounter.
Okay, let's list them out.
First, there's Form 8949, Sales and Other Dispositions of Capital Assets.
8949. What goes here?
This is your primary workhorse for reporting sales or exchanges of most capital assets. Think stocks, bonds, mutual funds, crypto, collectibles, even personal real estate like a vacation home, unless it belongs in a more specific form. It's also where you'd report gains from involuntary conversions of capital assets not used in business, non-business bad debts, and worthless securities.
So lots of common investment sales.
Exactly. You list each individual transaction here, description, dates, proceeds, basis. If you file jointly, you combine your transactions. The totals then feed into Schedule D.
Okay, so Form 8949 feeds into Schedule D, Form 1040, capital gains and losses.
Precisely. Schedule D summarizes all your capital gains and losses from Form 8949 and also receives inputs from other forms like 4797 or 8824 if they involve capital gains. It calculates your net short-term and net long-term capital gains or losses.
And Schedule D is important for?
It determines how much capital gain is taxed and what rates, short-term versus long-term. It also calculates your capital loss deduction limit, generally $3,000 per year, $1,500 if married filing separately, against ordinary income, with the rest carried forward. Managing gains and losses via Schedule D is key.
Got it. What about business property? Where do those sales go?
That's primarily Form 4797, Sales of Business Property. This is a really important form.
Why is that?
It handles several key things. It's used for sales or exchanges of property used in your trade or business, Section 1231 property. It separates out ordinary gains and losses from business assets. And crucially, it's where you calculate and report that depreciation recapture under both Section 1245 and Section 1250 that we just talked about.
So selling business equipment, buildings, livestock, it all goes through Form 4797.
Generally, yes. It sorts out the ordinary income parts, like recapture, from the Section 1231 gains and losses, which might get capital gain treatment.
Okay. And those special deferral strategies?
For like-kind exchanges, there's a dedicated form, Form 8824, like-kind exchanges.
Even if no gain is recognized?
Yes. Even if you fully defer the gain, the IRS requires detailed reporting of the exchange on Form 8824. You provide info on both properties, the dates, any boot involved, basis calculations, etc. It tracks the deferral.
Makes sense. And finally, the main return.
Finally, your Form 1040 or 1040 Air SR, your main tax return. This is where you check that yes or no box for digital asset activity. And ultimately, the net gains or losses calculated on Schedule D and Form 4797 after applying all the exclusions, postponements, and special treatments flow into your Form 1040 to determine your overall taxable income and tax liability. They all interconnect. Hashtag, tag, getting further help.
That was a tremendous amount of information. Wow. But hopefully it's given everyone listening a much clearer picture of how these asset dispositions actually impact your taxes and, more importantly, maybe revealed some real, actionable insights for finding those tax-saving opportunities.
It's definitely a complex area, no doubt about it. But being aware of the rules is the first step.
Absolutely. And armed with this knowledge, you're in a much better position to navigate it or at least ask the right questions.
And to help with those further questions, or to dig deeper into specific scenarios that apply to your unique situation, remember, the IRS provides a wealth of really valuable resources.
Like what? Where should people look first?
IRS.gov should always be your primary hub. It's the official force, constantly updated with the latest tax laws, forms, publications, and guidance.
Okay, irs.gov, any specific tools there?
Yes, the IRS Interactive Tax Assistant, or ITA, is fantastic. You can find it at irs.govvital. It's an online tool that asks you questions about your specific situation and then provides tailored answers and links based on your input. Great for clarifying specific points.
Like a virtual tax advisor?
Kind of, yeah. And of course, you can download all the current and prior year forms and publications directly from irs.gov forms. Publications like Pub 544, Sales, and other dispositions of assets, which was a key source for our discussion, offer extensive detail and examples. They're like free tax manuals.
Good point. What about free help for people who need it?
Definitely. Don't forget about the free tax help options if you qualify. IRS Free File at irs.gov Free File offers free online tax prep software from partner companies for taxpayers below a certain income threshold.
Okay, free file.
And the Volunteer Income Tax Assistance, VIDA program, irs.gov VITA, offers free tax help from certified volunteers. It's generally for low to moderate income individuals, persons with disabilities, seniors, and limited English-speaking taxpayers. They can be a huge help.
Vita, got it. What if you have a problem with an IRS you just can't solve?
If you've tried to resolve a tax problem through normal IRS channels and haven't succeeded, or if the issue is causing significant financial difficulty, the Taxpayer Advocate Service, TAS, might be able to help. You can find them at taxpayeradvocate.irs.gov.
PAS, Taxpayer Advocate Service.
Right, they're an independent organization within the IRS dedicated to protecting taxpayer rights and helping resolve persistent problems. They can be a real lifeline in difficult situations. All these resources are there to empower you.
These resources are truly invaluable. It's just so important to be proactive, right? In
Yeah.
your learning and your critical thinking when it comes to your own finances. The more informed you are, the better decisions you can make. So what does all of this really mean for you, our listener, as you look at your own assets and your future plans? Hashtag tag tag outro crap.
Well, we've taken quite a deep dive today into the sometimes murky waters of asset dispositions. We went from basic gains and losses to the really valuable home sale exclusion.
The complexities of involuntary conversions, the power of like-kind exchanges.
Right, and then into specific assets like QSBS, that amazing exclusion,
Yeah.
digital assets, selling a business, intangibles.
And capped it off with the critical impact of depreciation recapture and those tricky related party rules.
Our goal, really, was to offer practical insights, how these transactions can profoundly affect your tax bill, and maybe more importantly, how you can strategically save money through careful planning and just by understanding the rules and reporting. And remember, this knowledge is most valuable when you actually understand it and apply it to your own situation. We really encourage you to review your own financial records, maybe look at your assets with this new perspective.
Good idea.
And for specific situations, please consult the relevant IRS publications we mentioned, like Pub 544. But for tailored advice based on your unique circumstances, nothing beats working with a qualified tax professional. They can provide personalized guidance to ensure you're making the most tax-efficient decisions for you.
Absolutely. So, as you go about your financial life, think about this. Consider not just if you're disposing of an asset, but how you might structure that disposition. How can you align it with your long-term financial goals, keeping these sometimes intricate tax rules in mind?
Because the seemingly small details, getting the basis right, meeting those exchange deadlines, understanding recapture, they can truly make a monumental difference in your final tax outcome.
It really hammers home that being well-informed empowers you to make smarter choices. The little things add up.
They certainly do.
That's all for this deep dive. We hope you feel more informed, maybe a little more confident, and ready to navigate your asset dispositions with greater tax savvy. Until next time, keep digging into the details.